converted to DCPPs, and more sponsors are choosing to introduce a DCPP over a DBPP. This trend is likely to continue since many pension plan sponsors do not want to be responsible for pension fund returns, and the fact that plan obligation values increase as lifespans increase, as occurs with DBPPs. DCPP sponsors need not be concerned about investment returns or longevity of members. They set up a plan, make their specified contribution to the plan, and ensure ongoing compliance with regulators. The administrator of a DCPP is responsible for educating all plan members about the details of their plan. Members are provided with investment information to make informed choices of their investments. Providing this information is one of the sponsor's obligations set out in the CAP guidelines. Often, such education is provided by the insurer providing the plan in the form of online tools, a member-only website, mobile apps, newsletters, seminars, and other learning materials. The DCPP sponsor has a minimum financial obligation for each plan member, set out in the plan as a percentage of member income, and plans accordingly. There is no requirement to increase contributions over time. Sponsors have a number of ways to structure a DCPP for its members. They can make participation optional, require members to increase contributions over time, or restrict the number of investment options available. Like the DBPP, sponsor contributions are a tax-deductible expense and are not a taxable benefit to the plan member. The sponsor or administrator chooses investments that will be made available to plan members. Each member is generally responsible for choosing from among those investment options. In certain circumstances, the sponsor or administrator may choose the options for all members. The options may include segregated funds, mutual funds such as target date funds, a form of mutual fund that becomes increasingly conservative as the date on which the funds are needed draws closer, and guaranteed investment accounts. A DCPP can be very beneficial to the member who actively contributes, monitors, and manages his investments. He can access available investment options, switch among investments according to his needs and investment performance, and can tailor investment risk to his personal risk tolerance. On the other hand, some plan members may find the choice of investments both complex and confusing. This could lead to delayed decisions or a failure to make decisions. When a decision is not made or cannot be made with confidence, the default investment option may be used. This option, in almost half of DCPPs, is a target date fund. In Alberta, the default option is a balanced fund or a portfolio of investments that takes a member's age into account. The sponsor or administrator assists members to make suitable investment decisions, particularly those whose level of education, investment experience, or level of literacy indicates that such help is required. However, the onus for investing is on the group member to achieve their retirement savings goal. 8.2.2.3 Group Life Income Fund, LIF. The DCPP creates a pool of retirement savings for its members. When a group member with a DCPP decides to receive retirement income, he is required to transfer his savings to an account that requires minimum withdrawals. His savings are locked in. This limits his choices to income-paying accounts that accept locked-in funds. One of those choices is a LIF. The LIF can be set up by a person who transfers their pension savings, or it can be provided by the sponsor on a group basis. The group LIF allows continuity for the plan member and lower administration fees than the non-group alternative. LIFs require annual minimum withdrawals and restrict the maximum that can be withdrawn. They are available in all provinces, but sometimes under different names. The percentages for minimum and maximum withdrawals differ between provinces. The sponsor can present the group LIF as an additional advantage of employment to potential employees, a significant benefit for employees intimidated by the prospect of going it alone when retirement arrives and having to decide what to do with their pension savings. 8.2.2.4 Group Registered Retirement Savings Plan, GRRSP. GRRSPs are a type of savings plan that permit contributions by both sponsors and members. Anyone familiar with an individual RRSP, available through all financial institutions, finds a GRRSP easy to understand because the two plans are fundamentally the same. Total annual contributions to a group RRSP and an individual RRSP are limited to the individual's RRSP deduction limit for the year, as provided by Canada Revenue Agency, CRA, in the latest Notice of Assessment. Example: Reginald works as an assembler for an electronics manufacturer and earns $60,000 a year. He participates in the company's GRRSP, both the employer and Reginald contribute 5% of his earnings to the plan. Total contributions to the GRRSP are $6,000, 60,000 times 5%, times 2. Since Reginald's income was the same last year, i.e. $60,000, this year's RRSP deduction limit is $10,800, $60,000 times 18%. As Reginald's contribution to the company GRRSP was $6,000 for the year, he can contribute up to $4,800, $10,800 to $6,000, to his personal RRSP. One of the differences between an individual RRSP and a GRRSP is that the GRRSP does not generally permit purchase of individual securities, i.e. stocks. However, fees for a GRRSP are usually lower than an individual RRSP. Contributions made by the individual and the sponsor to the GRRSP vest immediately. Therefore, the GRRSP can be expensive for sponsors who have a high rate of staff turnover, since their contributions will have vested and become the property of the employee whenever the employee departs. There is an additional cost to sponsors of GRRSPs because their contributions are considered to be additional salary paid to members. Therefore, they incur payroll charges, such as employment insurance, on their contributions to the group plan. Sponsors who offer a GRRSP make no financial commitment to an eventual pension for members. Like a DCPP, members control their investment activity and contributions. They are responsible for the pension they create. A benefit of the GRRSP is that contributions are made through payroll deduction. This form of contribution typically makes saving easier. Contributions by the employer are taxable as income to the employee and are tax deductible by the employer. The sponsor of a GRRSP incurs no obligations other than collecting and remitting contributions of plan members. Therefore, this plan may appeal to organizations with limited resources to devote to plan administration. Maturity options are similar for individual and group RRSPs. Savings accumulated in a GRRSP must be transferred into a group or an individual registered retirement income fund, RRIF, or an annuity, the end of the year in which the account owner turns 71 at the latest, to continue tax deferral. 8.2.2.5 Deferred Profit Sharing Plan, DPSP. A DPSP plan is funded by employer contributions only. Contributions to the plan arise from profits. Years with lower profits may see the company suspend contributions. Therefore, a DPSP is most appropriate for those organizations with stable profitability to ensure that contributions to the group plan can be made annually and continually. Employer contributions and fees are tax deductible for the business and are not a taxable benefit to plan members. Thus, employer contributions are not subject to payroll taxes on federal and provincial government plans. This plan can be used to motivate employee productivity and performance, since contributions are linked to business profitability. Employees receive a tangible benefit from their efforts. As the company profits, so do they. However, employees who own 10% or more of the shares of the company cannot be members of the DPSP, nor can those who are related to the employer or a specified shareholder. One of the benefits of the DPSP is the ability of members to make partial withdrawals at any time. However, a plan sponsor can choose to restrict withdrawals while the member is employed. The sponsor selects the available investment options and members choose from those investments. Once again, like the DCPP and GRRSP, the sponsor does not commit to providing a specified future pension. A DPSP is often used in coordination with a GRRSP to which only members contribute. Employee contributions to the GRRSP are matched by employer contributions to the DPSP. DPSP contributions create a pension adjustment for members and therefore reduce RRSP contribution room. This arrangement is also possible with a DCPP. Example: Mark, a life insurance agent, has set up a meeting with a technology company to review their group savings and investment plan. The company set up their group plan, a DCPP, a few years ago, believing that the plan provided a way for the company to attract some of the best talent in their business, video gaming, without creating financial pressure on the company. However, since that plan was implemented, the company has grown astronomically. It is enormously profitable, and expects revenues and profitability to continue to grow. There is no problem hiring. The company is sought out by applicants due to the strength of its product line and commitment to ongoing development. The objective of the company is changing from using a group plan to attract employees to using a group plan to reward employees. Retirement income is not top of mind for employees right now since their average age is 36. Mark proposes a DPSP for the company. The DPSP can easily be funded from corporate profits, and it aligns well with the philosophy of this younger workforce who strongly believe company profits should be shared with those who help create those profits. Mark illustrates the benefits of the DPSP in comparison to the DCPP and any disadvantages. If the company proceeds, it will continue to offer its DCPP plan. Since the DCPP continues to provide dependability in case the fortunes of the company change, and the DPSP will start once it has been properly registered and a contract issued to the sponsor. Like a GRRSP, the money saved in a DPSP can be transferred to a group or an individual RRIF, or an annuity, to continue tax deferral. 8.2.2.6 Group Registered Retirement Income Fund, RRIF. DCPP, GRRSP, and DPSP members accumulate savings in their accounts, while the DCPP members' funds are locked in. Savings in GRRSPs and DPSPs are not. Therefore, these plan members need a registered account to which they can deposit their savings to continue tax deferral when they are ready to begin income. The Group RRIF is a plan that can be set up by the sponsor on the member's behalf in order to transition registered savings into pension income. A Group RRIF accepts transfers directly from the GRRSP or DPSP and offers its members the same features as RRIFs available to individuals. It requires a minimum annual withdrawal but has no maximum amount a member may withdraw. Savings in the GRRSP or DPSP must be rolled into the Group RRIF, or individual RRIF, no later than the end of the calendar year in which the plan member turns 71. While a RRIF may be set up at any age, it is advisable to set one up only when retirement income is needed, because once a RRIF is set up, mandatory minimum withdrawals must be made every year, with the exception of the first year. Withdrawals from a RRIF are fully taxable as income. The Group RRIF enables sponsors to offer retired employees continuing service, such as information brochures, webinars, and investment seminars, in addition to lower fees than individual RRIF accounts. 8.2.2.7 Group Tax-Free Savings Account, TFSA. The Group TFSA is a newcomer to the group market but is rapidly gaining in popularity as the public develops a better understanding of the product and the entire concept of a savings account that is tax-free. Tax-free means No tax deductions on contributions. No need for tax deferral. No taxation on withdrawals. As with other group plans, sponsors are not obliged to contribute. If they do, contribution is considered additional income. Sponsors are not responsible for providing a specified pension income to group members. A choice of investments is available. The group TFSA limits contributions exactly the same way as individual TFSAs. Each taxpayer is allotted an annual contribution limit, the dollar amount of contribution permitted for the year, plus any unused contribution room from previous years. That sum is available for his group plan contribution, his individual plan contribution, or a combination of both. In other words, one limit applies to the total of all contributions. The annual limit cannot be exceeded without stiff penalties. An important benefit of the group TFSA and the individual TFSA is that contribution room is independent of other plans. Therefore, the maximum contribution can be made to a TFSA and an RRSP. Moreover, members benefit generally from lower investment fees as compared to individual plans. Unique to the group TFSA, as compared with other group plans, is the ability of plan members to make tax-free withdrawals at any time, since contributions are not locked in. This provides flexibility for savings. Example: Darlene is the owner of a small, prestigious real estate firm that serves a niche market in a wealthy suburb. Her employees, all real estate agents, are at either end of the usual working age, either their mid to late 60s or in their mid to late 20s. They all earn significant six-figure incomes every year, and have enjoyed high earnings for the past number of years. Darlene's financial success is a result of her agent's success, and she wants a group plan that will recognize employees' lengthy service without creating a significant tax burden for them. She knows that they have all made maximum RRSP contributions and have no available contribution room. They all pay tax at the highest marginal tax rate. Darlene needs to retain her long-standing employees. She knows from experience that the younger ones are not particularly loyal, but the older employees are. None of them plan to retire in the foreseeable future. A group TFSA does not have a maximum age for contributions, so, on this basis, is a good fit for Darlene's older employees. Darlene creates a group TFSA for her more experienced employees on the basis of their years of service. Those who have worked for 10 years or more for Darlene are eligible to join. Darlene contributes the annual maximum to each employee's plan and is quite happy to bear the cost of contributions plus additional payroll taxes. The agents can take withdrawals from the account whenever they wish, on a tax-free basis. This approach is very tax efficient for the members of the group plan. 8.2.2.8 Pooled Registered Pension Plan, PRPP. The PRPP is a relatively new type of group pension savings plan intended for individuals who do not have pension plans available through their employer or for those who are self-employed. They access the plan through licensed PRPP administrators. Administrators include some large life insurance companies. PRPPs are available federally and in all Canadian provinces and territories. Quebec has adopted an equivalent plan, the Voluntary Retirement Savings Plan, VRSP. The PRPP gives smaller companies a pension plan to offer employees without the compliance requirements of other group plans. Plan members benefit from lower administration costs than through individual savings options and the portability of their rights. As members change jobs, the PRPP follows them. Employers may contribute to the plan in addition to employees. Contribution limits are the same as individual RRSPs. They make no commitment to a future pension. Contributions made by the employer are not included in the member's income, and they are not tax deductible for the member. Account values are creditor proof. They are locked in and can be cashed out only due to disability, loss of Canadian residency, or if the account is less than 20% of the annual year's maximum pensionable earnings, YMPE. Otherwise, when employment ends, they must transfer to a LIRA, LIF, another PRPP or used to buy an annuity. On death of the plan member, the spouse receives the account value or, if there is no spouse, a beneficiary receives the money. 37. 8.3 Group Plan Investment Options. One of the significant benefits of group plans for members is the lower investing fees members pay in comparison to individual investors. This puts more of their savings to work as investments. When the group investment is a segregated fund, the management expense ratio, MER, is less than what an individual would pay. The lower fee means a larger retirement fund can be built. Example: 10 years ago, Janet's contribution to her DCPP was $4,000 for the year. She invested in the most growth-oriented segregated fund she could identify. The fund earned 10% annually and, because it was offered through a group plan, the MER was just 1% per year, net return of 9%, i.e. 10%, 1% MER. After 10 years, Janet's initial investment was worth $9,469.45, $4,000 times 1.0910. If Janet had made the same investment outside the group plan, the MER charged would have been 2% per year, net return of 8%, i.e. 10%, 2% MER. After 10 years, Janet's initial investment would be worth $8,635.70, $4,000 times 1.0810. Therefore, in 10 years, Janet was able to increase the value of her initial investment by $833.75, $9,469.45, $8,635.70, due to the lower management fees charged to the group. Group members choose from the investment options made available by their plan sponsor. These can include segregated funds and annuities. 8.3.1 Segregated funds for groups. Segregated funds may be an option made available to members of pension plans in which the member makes the investment decision. Therefore, they may be offered to members of all plans, except those enrolled in a DBPP. 8.3.1.1 Types of funds available. Like the segregated funds available to individual investors, there is an enormous amount of choice. For instance, bond, equity, target, balanced, or specialty funds may all be made available through a group plan. However, the actual segregated funds offered to group members as an investment option in a customized group plan are picked, sometimes with the help of the agent, by the sponsor or administrator. They ensure that group members have a choice between funds that offer capital preservation, growth, or income alone, or in combination, such as a balanced fund would provide. 8.3.1.2 Advantages and disadvantages of group segregated funds. Segregated funds available to group members have a number of distinct characteristics compared to segregated funds available on a personal basis. Unlike segregated funds offered to individual investors, segregated funds for group members have no sales charges. This means savings can be invested in full, without a sales load. They also do not charge switch fees for group members. Also, the MER on group-provided segregated funds is generally lower than the MER paid by individual investors. This is due to the primary disadvantage of group segregated funds: they do not offer a maturity or death benefit guarantee nor group plan special rates. The absence of these guarantees increases risk of investment loss for the group member. 8.3.2 Annuities for groups. Annuities for groups are provided for the group itself, for group members, and for retiring group members. 8.3.2.1 Types of annuities available. Sponsors that introduce DBPPs face considerable risk in funding their future pension obligations. They must predict, with the help of actuaries, how much they should set aside in their pension fund for future pension payments. They are concerned with the future rate of return of the pension fund and retirees' longevity. A way to manage that risk is for the sponsor to buy annuities from an insurer in a pension buy-in. An insurer sells annuities to the pension plan sponsor that have guaranteed payout rates that match the sponsor's pension obligation. The insurer then becomes the provider of the pension benefit. Therefore, the insurer takes over the risk of funding the future pension from the sponsor. The benefits promised to retirees are unaffected by the change in provider. This concept of a guaranteed pension also applies to DBPPs for companies that wind up their pension plans because they go out of business. Their pension obligation does not end, even when the company shuts its doors. Their retired group members receive their pensions as expected from the insurer. Members of a GRRSP may be provided with the investment option of an accumulation annuity for their savings. The annuity pays guaranteed interest for a fixed term or a date specified by the investor. Members of a DBPP have a life annuity option when their contribution terminates at retirement. Members in a GRRSP and DPSP have the option of a term annuity or a life annuity. Life annuities may be available as a joint and last survivor annuity and provided with or without a guarantee. Period. 8.3.2.2 Advantages and disadvantages of group annuities. Annuities provided in the group context provide the same reliability of income as those provided to individuals. They provide security, stability, and peace of mind. Their disadvantages are also the same. There is no flexibility for withdrawals and they cannot be terminated once payments begin. Pension payments are linked to the annuity rate at the time of purchase. Since payments will not increase if interest rates rise, the annuities therefore carry interest rate risk and inflation risk. 8.4 Group Plan Recommendation. The agent must carefully formulate the recommendation for a group plan, just as he would do for an individual. Although he may be working and negotiating with one entity, the sponsor, or administrator, he must never lose sight of the group members that this administrator represents. The agent should consider the demographics of members, their general level of skills and expertise, their education, and their degree of employer loyalty, as measured by employee turnover. He needs to understand the objectives when the group is initiating a savings and investment plan for members, and what factors motivate a group with an existing plan who may be considering changes. The agent has a disclosure obligation to his client, the sponsor. He must inform the sponsor of the insurers that he places business with, particularly the firm that is being recommended for the sponsor's policy. The agent should focus on those companies he places business with most often, or most regularly, instead of an exhaustive list of every single company with which he has dealings. In Quebec, an agent who is bound by an exclusive contract with an insurer must disclose this fact to his sponsor customer. It is also necessary for the agent to inform the sponsor if there are financing arrangements in place between an insurer and the agent. This includes whether a loan had been provided by the insurer to the agent or if there is a commission advance on the sale. These types of arrangements can be viewed as a conflict of interest. Otherwise, the sponsor must be provided with the basic information about how the agent is compensated for the sale, whether by commission or a fee, and if a bonus or travel incentive exists. Specific dollar amounts must be provided if the sponsor requests such details. The agent must also obtain written approval from the sponsor if he receives an increase in compensation after the sale is completed. The agent must be prepared with executive-level presentations of his recommendations, since the sponsor may want to question the agent directly about his suggestions, including plan specifications, plan and investment recommendations, pension credits and adjustments. One important aspect of plan design is when or under what conditions a group member is entitled to receive a full or partial pension, since this will have a direct bearing on cost for the sponsor. The DBPP may specify a set age, i.e., 65, or it may specify a required number of years of employment, called service, or it may be a combination of age plus qualifying years of service that must be satisfied before the full pension can be paid. The generic formula of age plus service is called a qualifying factor. It is more commonly known by the actual number associated with a plan, such as the 85 factor. However, it does not have to be the number 85, at one time it was known as the 90 factor. It could just as easily be the 75 factor. The employee adds together his age and qualifying years of employment with the sponsor. For instance, an employee who is 55 and has 30 years of employment meets an 85, 55 plus 30, factor. If his pension required the 85 factor to be satisfied in order to qualify for a full pension, then this employee could retire with a full pension at age 55. The plan may also specify a minimum age at which the full pension can be received. If the full factor cannot be satisfied, either because the employee does not have enough years of service or because he is too young, then a partial pension may be paid. The conditions for paying the partial pension will be described in the plan document. 8.4.1 Review of Plan Specifications. There are many aspects of group plans that enter into a recommendation and final decision. Key factors and related questions to be taken into consideration are: funding. Will there be a sponsor funding commitment, and if so, how much annually? Will contributions be uniform across all group members? When will vesting occur? Costs. What are the annual costs of each type of plan to the sponsor, including contributions and administration? How will the sponsor determine the age at which a full retirement pension will be paid? Sponsor characteristics. Is the sponsor anticipating significant growth in its workforce? How does this impact the group plan? Group members. Is it more important to retain some members than others? How can the sponsor ensure members participate? Is the sponsor prepared for its commitment to educate members when the plan falls under CAP guidelines? Administration. Who will the administrator be? 8.4.2 Recommendation for a plan and its investments. Developing a recommendation requires the agent to comprehend the composition of the group in order to understand whose needs will be served and whether needs are short-term or long-term. For example, if the group is comprised of members for whom, on average, retirement is very distant, then a plan that provides retirement benefits alone may not be the best fit for that sponsor or its members. When a group is more likely to be motivated by a plan that satisfies more immediate needs, then, for instance, a GRRSP could have much higher appeal since it may be used to assist in accumulating a down payment to purchase a home through the home buyer's plan. The GRRSP may also fund adult education expenses through the Lifelong Learning Plan, LLP. A group TFSA may also appeal because withdrawals are permitted. This flexibility for savings and withdrawals can be very attractive to those with short-term cash requirements. A DPSP can have an immediate effect on employee morale and retention when employees receive deposits to their plan from their employer. Unfortunately, there could be a reverse effect if an employer is unable to make a contribution due to poor profitability, and especially if that condition is repeated consecutively over a number of years. When the administrator and agent have reached certain conclusions and agreed on how to proceed, the agent develops his recommendation for the most suitable type of plan and its investments with the group specialists at the insurer or insurers he represents. The group specialists have expertise in the many aspects of group plan structure and delivery. They also keep informed of changes in legislation and compliance requirements to enable the agent to prepare an accurate and comprehensive recommendation. The sponsor must be prepared for its funding obligation and the effect that this funding has on profitability and shareholder expectations. 8.4.3 Pension Credits and Adjustments. Pension credits are created in plans every year except in GRRSPs, PRPPs, and Group TFSAs. The pension credit is a measure of the value of the benefit the member earned or accrued during the year. The fiscal year for participation in the pension plans is the calendar year, January 1st. December 31st. However, a plan may be implemented at any point during the year. The method an employer uses to calculate pension credits depends on the type of plan and its provisions. Pension credits for DBPPs, DCPPs, and DPSPs are calculated to determine a member's pension adjustment, PA, for the year. The PA reduces the amount that a member can contribute to an RRSP or a PRPP in the following year. Therefore, the formula for an RRSP or PRPP maximum contribution for a DBPP, DCPP, or DPSP member is contribution based on previous year's earned income to annual maximum pension adjustment equals this year's contribution limit. Example: Ahmed's maximum contribution limit for his RRSP this year is 18% of his previous year's earned income. His earned income for the previous year is $48,000, so his maximum RRSP contribution is $8,640, $48,000 times 18%. His pension adjustment for last year was $3,300 due to the contributions made to his DCPP at work. Therefore, he can contribute $5,340, $8,640 to $3,300 to his RRSP this year. Contribution room to an RRSP and PRPP can be increased by a pension adjustment reversal. PAR. If too much has been taken as a pension adjustment, PA, in a year, for instance, due to the plan member retiring or being terminated during the year, then the PA is recalculated. The difference between the full and the reduced PA is the PAR. A sponsor may increase benefits of a plan, for instance, by crediting all members with additional years of employment or by retroactively increasing the benefit formula. This creates a past service pension adjustment, PSPA, for the member. A PSPA reduces RRSP contribution room. The administrator must calculate and report PSPAs. When presenting his recommendation to a plan sponsor, it is important that the agent explain the tax effects of participation in the pension plan with the PA or the PSPA, if the plan is amended retroactively. 8.5 Group Plan Documents. The group application to the insurer may incorporate suggestions provided by the agent and insurer or may be the result of a sponsor decision. Many documents must be provided to the pension authority in the jurisdiction in which the plan is being registered by the plan sponsor. Like all forms that the agent has a role in completing, those required to establish a group account must be filled out accurately and submitted in a timely manner to the insurer. The insurer that manages the pension fund for the sponsor provides a regular financial report to the sponsor. The report keeps the sponsor informed of investment income and benefits paid to members. It also provides information on the allocation of funds among investment options and among the members. 8.5.1 Application. A group application is completed first by the administrator on behalf of the group. The application goes through underwriting by the insurer. When the application is accepted, the contract is then prepared naming the sponsor or the administrator as contract owner or holder. Once the application for the group is approved, group members can apply on their own behalf to join the plan as they become qualified. Members may not enroll until their waiting period has been completed. All members entitled to participate in the group plan by virtue of plan design are accepted. For instance, a plan could be set up so that all employees who have worked for the employer for 6 months are entitled to join the pension plan and are automatically enrolled. 8.5.1.1 Member Forms. Many forms to be completed by members are provided through their group administrator or a website that provides secure member account access. Membership enrollment is the first form for a member to complete. Members will thereafter receive a certificate of membership that details the many aspects of their plan. It includes an identification number. Members have other forms available to meet their needs. At the time of enrollment, they may have forms to name, or change, a beneficiary or provide a waiver of a joint and last survivor pension or a waiver of a pre-retirement death benefit. A member may also temporarily leave the plan due to disability or maternity leave. A leave of absence form is provided to accommodate a suspension of contributions for reasons specified by the plan. Using this form also means the member does not need to satisfy another waiting period to rejoin the plan after he returns to work. Finally, at retirement, the plan member must provide a notification of intended retirement some months before retirement actually occurs. Income begins at the selected date, if plan requirements for minimum age or age plus service have been met. 8.5.2 Account transfer. Members with locked-in pension contributions may be required to transfer the value of their pension plan when they no longer work for the plan sponsor, due to retirement or a change in employers. The administrator facilitates transfers according to the instructions of the member. Agents have a client service opportunity with those group members. If the member has, or will have, the opportunity or obligation to move his pension plan savings, the agent could initiate a discussion about transfer options in preparation for such an event. This conversation can develop from consultation with a prospect or client on any life, health, or investment product. 8.5.2.1 Transfer options. The sponsor follows the instructions of the plan member when he leaves the plan due to a change in employment or retirement. Options available for transfer depend on the type of plan and whether the plan member wishes to continue savings, and its corresponding tax deferral, or to begin receiving income from his savings through withdrawals. Whether income may start partly depends on age at the time of transfer, since withdrawals may not be possible before a specified age. A member from a DBPP who quits can transfer the commuted value of his pension into the pension plan of the new employer and be recognized for years of service under the new plan only if there is an agreement transfer between the two plans. The terms of pension plans are not all the same. The value of one plan may not be equivalent to another plan and a shortfall can arise. If so, the employee can contribute the sum needed to make up the shortfall in a lump sum within a specified deadline or prorate the amount of transfer. Plans may also differ as to when a pension is available. A group member would likely not want to transfer commuted value from one plan that permitted retirement on a full pension at age 62 to another plan in which the full pension is provided at age 65. The group member of a DCPP may also be offered entirely different investments if he transfers to another pension plan. Even if he finds the new range of options unsuitable, the transfer cannot be undone. Once the funds are switched, they are permanently embedded in the new plan unless the employee once again changes employers. These many conditions must be carefully considered by the group member before a group plan to plan transfer is contemplated. A transfer of accumulated funds to a locked-in retirement account, LIRA, or other self-administered plan, eliminates the problems associated with a group plan to plan switch. The account owner must be prepared to make investment decisions as he goes it alone. For best results, he should be knowledgeable about the investments available to him and be prepared to monitor his account regularly. He takes on the responsibility of creating the equivalent of the pension income for himself and his spouse. Table 8.1 highlights the responsibility of the plan administrator when a plan member leaves his employer or retires. In either case, the administrator acts according to the employee's instructions. 8.6 Agent Service Requirements. Agents may initiate the process of implementing a group savings and investment plan by identifying potential sponsors and meeting with them to illustrate the advantages of such a plan. Throughout the entire process of group sales and service, the agent facilitates matters, responds to the sponsor's needs, and is the point of contact and source of group information for the insurer. While a quote is being developed. 8.6.1 Review Plan with Sponsor. The agent must seek regular input from the sponsor or administrator about the existing plan to retain and enhance the business relationship. Reviewing a recommendation that has been made and not acted upon can be important in building group business. The agent's recommendation may have arrived at an inopportune time for the sponsor, and the sponsor may not have been able to reveal its reasons for inaction. Those reasons may have changed or been eliminated, and the agent may find the sponsor becomes responsive to the idea of a plan in future. 8.6.1.1 Annual Review. An annual review meeting, whether actual or virtual, gives the agent the opportunity to reinforce the value of the plan in meeting the sponsor's objectives. It is also vital to discover if those objectives are changing. It is essential for the agent to stay informed of changes to group savings and investment products, such as the introduction of the Pooled Registered Pension Plan, PRPP, and how those changes could affect the sponsor's plan. He should also maintain a high standard of knowledge about pension trends to discuss impacts with the sponsor. 8.6.1.2 Change in circumstances. Just as important as providing information to a sponsor or administrator is the agent's service role in bringing information about a sponsor back to the insurer. The insurer needs to know about changes to composition of a workforce, both growth and shrinkage, financial circumstances of the sponsor, change in administrator, and other relevant details. A sponsor may choose to wind up, or end, its pension plan. This requires filing the necessary forms with the provincial pension regulator. The value of the pension plan is held in trust for its members and cannot be accessed by the sponsor. Other conditions under which a plan is wound up include Black small square the sale of all or part of the business to a new owner that does not provide a pension plan. Black small square the business is downsized or closed. Black small square all or most members are no longer employed with the sponsor. Black small square bankruptcy and insolvency of the sponsor. 8.7 Claims by group members. A claim from a group member is initiated to receive the funds in his plan. In order to make a claim, a group member needs to provide the group name and certificate or identification number to the insurer. The appropriate claim form must be completed by the group member to enable the claim to be processed. If a group member dies, the spouse will be called upon for information to enable his claim to the pension proceeds. This type of claim needs to be handled efficiently since the surviving spouse may need to access the proceeds of the plan. As discussed previously, forms may be accessed online or through the administrator. Whenever the agent is involved in the completion of forms, he needs to devote his full attention to detail, to ensure accuracy and completeness of information. 8.7.1 Claims for exceptional circumstances. Contributions to some group plans are the basis for locked-in savings. Withdrawals cannot usually be made by the group member when savings are locked in. Their purpose is to fund retirement income. However, there are some exceptions to the locking-in rule that allow the savings to be accessed earlier than they would otherwise be available or in larger withdrawal amounts. These exceptions vary by province and whether the pension is provided by a federally regulated industry. But fundamentally it is possible to unlock funds when life expectancy of the contributor is shortened, financial hardship is proven, the member is no longer a Canadian resident, the balance of the account is less than a specified sum, funds are being transferred to a life income fund, LIF, or restricted life income fund, RLIF for federal pensions, and a partial withdrawal is available. Claims being made under any of these circumstances require that the necessary forms be completed by the group plan member. Conclusion. Segregated funds and annuities are important investment products that help individual and group investors save, accumulate wealth and create retirement income. Their many benefits include Their backing by Canadian insurers, which are among the most financially robust financial services companies in the world. This status can give Canadian investors great confidence in both the products and the companies that create the products. The life insurance agent must always ensure that his recommendation of investments is in the client's best interests. To do this, the agent must understand the client and his investment objectives. Regardless of the agent's belief in the strength of the segregated fund or annuity investment, if the investment is not suitable and does not serve the client's needs, objectives, and risk tolerance, then the agent must not pursue his recommendation. However, when the recommendation for a segregated fund or annuity is the right fit for the client, the agent can achieve a great deal of satisfaction in knowing that he has provided a valuable service and product to a client that can help achieve financial objectives. Being in the business of providing investments also means the agent needs to keep on top of new developments in investing, including the introduction of new products, new trends, new analyses, and new requirements for compliance. Reading this manual has been the start of the learning process. It leads to ongoing responsibility and rewards.